Hello, Profit Hackers. I'm Jeremy Lott, the Chief Visionary for Foundation Accounting and Consulting. I owned a construction company for about 15 years before making a change to accounting because my accountants sucked. My goals are to simplify accounting for construction company owners, fuel your profits, level up your cash flow, and help you grow in a financially responsible way. So let's go. Welcome back, Profit Hackers. Today we're going to talk more about the hill and what all goes in that hill. But first, I want to explain why I call it a hill, right? The reason I call it a hill is because your costs, the on-the-truck costs, are a percentage of every revenue dollar, right? If you double your revenue, your costs are going to double. Your gross profit margin as well will double the dollar amount, right? But it's always going to be a percentage of the revenue. Your other expenses, selling, general, and admin, and a couple of the other things we're going to talk about, including today, are not going to double if you double your business. You may have to hire additional people, or you may have to get additional software as you grow, right? So that hill could definitely change sizes. But for the most part, that hill is going to remain the same, right? So in the next video, we're going to talk about the break even and how we can calculate what we need to get over that hill. But for now, I call it a hill again because these are the expenses that we have to cover throughout the year before we can get into that valley of profits on the other side. Okay? So I want to start off as we talk about some other things that go in the hill. We talked previously about the generally accepted accounting principles, or GAAP, right? This GAAP is the little box that your accountant lives in. And this little box tells him or her where they can put the revenue, when we can consider it revenue, when we can consider it a cost of goods sold, when we can consider it an expense down below, right? Likewise, for the balance sheet, it tells us that that little box gives us a set of rules for what can be considered an asset, what can be considered a liability, and what can be considered equity, right? So there are a lot of rules. And your accountant follows these rules so that your financial statements can be compliant. When you're looking to get lending, when you're looking to bring on an investor, or when you are filing your taxes, you have to be in that box, right? But we're going to talk a little bit about some out-of-the-box thinking and a different way of looking at your numbers and what goes in the hill that we're talking about, right? So first, I want you to imagine, if you can, a large pizza cut into 8 slices, right? You and 7 of your friends are going to share that pizza. But you are the one who bought it. You know, you definitely should be entitled to more pizza, right? So how do you solve that problem? How can you get more pizza out of those 8 slices, right? Most people, their first thought is, I'm going to cut a little slice of each slice and add that to my piece, right? That's going to increase the amount of pizza that I get, but it decreases the amount that everybody else gets. This is a very scarcity mentality, right? To think that there's only this much, and in order to get more, I have to take from somebody else. That defines scarcity mentality, right? But what if instead you made the pizza bigger? If you make the pizza bigger, you can take more pizza And you could potentially give everybody else more pizza, right? This is an abundance mindset. This is why when we are working on improving our gross profit margin, we focus on our bidding and our revenue rather than focusing on what costs and expenses can we cut to put more money in our pocket, right? We want to make the pizza bigger, not shrink it, okay? So out of the box thinking and abundance mentality. So let's apply that out of the box thinking to our GAAP principles, that little box that your accountant plays in, right? On your profit and loss, you do not include some of the things that you actually pay for, right? Otherwise, that gross profit at the bottom would be the exact same as your bank account, but it's not. It never is, right? So the reason that's the case is because we are paying for some things that are over on the balance sheet. Some of those things include credit cards. It includes accounts payable. It includes loans. Those kind of things you are going to have to pay for out of your bank account. But that never shows up on your profit and loss. Those amounts that you pay come out of your profit. So when we are looking at our hill and our break even, and we're trying to figure out how much we need to bring into the company revenue wise in order to be able to break even, we have to know the true size of that hill. Because at the end of the day, I don't care what my net profit is on my profit and loss, right? I don't care what that number is. What I care about is how much goes in my personal pocket. That's what I'm focused on. That's what I'm most interested in, right? So in order to do that, we need to think out of the box a little bit, just like with the pizza. And we are going to take some of those items on the balance sheet that we pay for, and we are going to roll them over into the hill and include those items in our hill so that we know how much we have to pay in order to get over that hill and into the valley of profits on the other side, right? So let me clarify. On your balance sheet, you might have loans that you're paying for equipment. You might have loans that you're paying for vehicles, right? These different kind of things. Those things don't go in the hill. We're actually going to include those costs with our on the truck costs. So if we were to go back and make some adjustments, we're going to take our payments for those vehicle and equipment loans, and we're going to instead move them over to our on the truck costs, right? So that'll increase our costs and lower our gross profit margin. Okay? With these other items, though, for instance, if you have an outstanding past due credit balance on your credit card, meaning you are not putting costs on your credit card and paying it off when you get paid, but instead you have old amounts that are sitting on there, you've got to pay that off, right? So we're going to include that minimum payment as part of the hill. The same thing is true for things like your accounts payable. Accounts payable means that I go in and I buy something from you, and you are going to send me a bill, and I will pay for it later, right? So from the time that you purchase it to the time that you pay for it, that amount goes into accounts payable, right? So when you go to one of your suppliers and you have an account and you buy something, that amount goes on your accounts payable. It's part of your accounts payable, right? So we may have outstanding overdue balances for accounts for customers' jobs that we have already completed and already been paid for. But because we weren't managing our money very well, we weren't able to pay off those amounts, right? And in future videos, we're going to talk in detail about how to manage that and how to take care of that, right? But for the time being, anything in accounts payable that we have sitting there from customers that we have finished and been paid for need to go onto that hill. And we need a payment amount, not the total amount, unless your goal is to pay it all off in 1 year. But we need to figure that out and include that as part of our hill that we have to get over, right? And then the last thing is credit cards, which just like before, just like we've spoken before, anything that you've put on the credit cards that's outstanding and that was for jobs that we have been paid for and finished already, or for any selling general and admin expenses that are outstanding and we haven't paid that card off, we're going to want to add that minimum payment to the hill. The same thing is true. The same thing is true for our loans. Like if you have an SBA loan or line of credit, that's usually going to be more for working capital, which is selling general and admin expenses, than it is going to be for vehicles or for equipment to help to grow the company, right? So our minimum payments for any of those loans would then go in the hill as well, right? So we have those three main things that need to be added to the hill on top of our selling general and admin expenses. The outstanding accounts payable, the outstanding credit card, and the outstanding loans. And again, the caveat there is that they are all related to selling general and admin expenses, or they are related to customers that we've already finished and been paid for and haven't yet paid off those outstanding debts. Okay, so that's how we define that hill. So our total hill is the sum of those items, and that is the total amount we have to get over each year in order to get into that valley of profits on the other side. So thank you very much. I hope that made good sense for you. Have an abundant mentality, think out of the box, and please realize that your accountant is doing things correctly. They are following the protocol that has been set up for that box for GAAP, right? But in order to make better business decisions and to understand your numbers a little bit better, we do have to get out of that box and start thinking a little more creatively. And that's what we're teaching you here. So thank you very much. Next time, we're going to talk about how we can use the size of our hill to help us know how to break even in future years. So thank you very much, and I will talk to you again next time. Thanks for listening. If you found this episode helpful, please like and subscribe for weekly episodes to help you fuel your profit, level up your cash flow, and finance your growth. Until next time, go enjoy some green M&Ms and protect that cash.